Hello, welcome back to another video. Please like and subscribe, it really helps out the channel. Today we're going to look at two different stocks, but firstly let's just have a look at the overview of the S&P 500 and how it's trading over the last few days. So obviously it's down still 3.5% from almost all-time highs back in the end of March. And it has had a little rally from last Friday's lows up to about 2%. This is because of reducing tensions in the Middle East and has also resulted in the oil price dropping a bit, and therefore interest rate expectations. Well, I wouldn't say they move forward, but then they haven't moved any further back. The whole global supply chains and all that, those fears have been receded a little bit. Okay, so the first company I would like to talk about is Mr. Cooper Group. They're trading at near $80 a share, up 24% year to date, and actually trading near all-time highs. So normally I get a bit worried about buying companies at all-time highs, but there's a very good reason Mr. Cooper is, and that's because its earnings per share growth has been very strong over the last couple of years and expected to be very strong over the next couple of years as well. So who are Mr. Cooper Group? They provide a variety of products and services in financial services for mortgage companies across the US. As see here on the website, is one of the nation's largest mortgage services, supporting over 4 million customers on their home ownership journey. They also provide sub-servicing. So they've got the best-in-class platform and highly skilled team members. And one of the largest sub-services in the industry, service loans on behalf of banks, non-bank, and mortgage companies. So they also provide private label servicing, special servicing, master servicing, and direct consumer originations, and lots more. So they've released earnings today, looking very positive. There's an earnings call later on, which I'll also have a listen to. The earnings came in at $2.28 on an adjusted for non-recurring gains basis. This was above estimates of $2.11 per share. And also there was a revenue beat as well at $564 million compared to $498 million. So I expect the shares to bounce as a result of the beat here on the earnings estimate. So having a quick look at the earnings estimates. So as you can see, previous year 7.3, and as they're trading at $77, I think it might start higher today. So you could even see $80. So on a previous year's guidance, we were about 11 PE. But for this year, 2024, we've got an average estimate of 9, and we've already beaten that for this Q1. So hopefully, potentially, that's we're even looking at around the 9.6 for the year, because the beat was about 0.1, 0.2. So if you that average out for the year, we're probably actually looking at the higher estimate. But this is just a guess. And then increasing again another 20% earnings in 2025. So this is a high growth company. The revenues also showing decent growth, 17% this year and nearly 11% in the next year. The EPS trend has also been fairly positive, which is always good to see because it provides momentum to the stock price. So 90 days ago, 8.36 this year, but now it continues to be going up, and now staying at 9.06. And as I said a second ago, I wouldn't be surprised if that gets upgraded further. Next year, again, similar, looking at 11 when it was 9.88. And as you can see here, the number of revisions in the last 30 days of the current quarter has been 6 upwards, no downwards, and last 7 days up 1. So just going on to Barron's, as you can see, they are actually up over 3% pre-market. Pre-market's obviously very volatile, so we'll see where that ends on the day. And I didn't actually realize the earnings were out today when I was making this video, so it's a bit annoying because I was planning to purchase some over the next couple of days. But I still, even if they go up 3%, that's nothing on positive earnings. They still seem to be a bargain, at least in my opinion. But see, on the Barron's website, they also show 2026 guidance, and knowing that they are now in 24, so that's 2 years ahead. This is Q1 24 that's been released today. You're looking at 2 years ahead for a company that could be quite cyclical, depending on the interest rates and housing transactions. 14.5 is obviously would make this almost trading at a 2-year forward PE of around 5.5, which would make this look even cheaper. See, the company has been buying back shares quite a bit. I think they bought over 25% since 2020. So you got 91 million here and 67 million outstanding at the moment. So I think that's around 7-8% compounded each year. I think they've actually bought further since then, so 67, and then now got 64 million shares outstanding. So they are buying back a huge amount of shares, which will boost that earnings per share. Balance sheet looking fairly strong, decent amount of cash. There will be a large figure for total debt here, but that's because they are a loan company, and that's how it works. It gets balanced out, but they will make adjustments for bad debts and things like that. But so total debt, I wouldn't worry too much. It's more about looking at make sure they got enough cash and the equity figure, which the equity figure has been growing very strongly. Knowing that this is a 5 billion market cap stock, and it's grown from 2.5 to 4.28 billion over the last 4 years. That's per the market cap. This is massive increases, and at the same time, they've been buying back 8% of their shares, which is why I think this Mr. Cooper is a potential bargain. There are, of course, risks. I mean, with all these finance companies, loan companies, but that they manage the loans correctly with the right amount of risk. But I think the risk reward here is definitely in their favour, and why I will be picking up some shares myself very soon. So TripAdvisor is the other one I've been looking at. A company that you probably haven't really thought too much about as a share, but I hadn't. And to be honest, they've been on a bit of a good run since September. They've been up again 50%, but nowhere near where they were 5 years ago at around $50 a share. So that's down over 50%. I'm treating TripAdvisor as a bit of a turnaround play. We can just quickly go to the earnings per shares. As you can see, the earnings estimates. As you can see, a year ago they were 1.29, so that would make them approximately trading at a trading PE of around 20. But this year we're looking at an increase to 1.46 with a low estimate of 0.86 and a high estimate of 2. So that there is a bit of a difference there. But if at 1.5, that's a healthy, 10% increase in earnings per share. But then also looking at 2025, there's an even bigger jump to 1.91, which this would be trading at about 13 PE next year, which I think is pretty good for a company like TripAdvisor, growing at 9% revenue and 8% next year. They got their earnings release on May the 1st, which should be quite interesting. So with TripAdvisor trading at currently $26 a share and expecting 1.9 earnings per share by next year, which was higher than what they were getting back in 2015, and yet in 2015 they were trading at 60, 70, even up to $96 per share at a PE ratio, 30s, 40s, 50s. Even if we got half of that PE, we would probably be looking at a share price of $35 to $40. So almost 100% increase from today's value. The share's up 21% year to date and 51% on the 12 months. Just look at the income statement now. As you can see, obviously big decline in 2020 due to the COVID pandemic, but has bounced back since then to 49% growth, 65% growth, and near enough 20% growth last year, which means they're they're at 1.79 billion. 23 is now higher than they were pre-pandemic. And if they're expected to grow further this year and next year, I also think that means they are on the right trajectory. Net income obviously got hit hard in the pandemic times, and therefore, but at the same time, their outstanding shares haven't increased. They've been flat, which is nice to see. Cash levels have been growing, so 300 million in 2019 and now 1 billion 2023. It's good to see that intangible assets have been decreasing as well from 950 to 872. Still high, but it's expected on some of these tech companies that purchase other companies instead of organic growth. Short-term debt, nice and low, good to see. Long-term debt has been rising as a result of the back of the pandemic. There was instead of issuing shares, they've gone into their banking sort of overdrafts. So that's an increase of 750 million since 2019 on the debt. But if we look at the cash, it is up 700 near enough million. So they haven't increased their net debt by much, if anything, really at all. Total equity has fallen from 1.16 billion to 870 million, but there's been a stabilization since 2020. So that's nothing too much to worry about. I think the thing with TripAdvisor is if they do reach their targeted earnings per share or what the analysts think they will get, then there could just be a realization in the share price. And I think at least 60-70%, but I could easily expect TripAdvisor to double. I don't think there's as much of a buy as Mr. Cooper, but it's definitely one on my watch list, and I may open a small position. We've got a bonus share to look at, but it's not really a share because this is who Hibbett is, a sporting retailer who JD Sports have bought out for $1.1 billion. I think it was a good. I've made a previous video on JD Sports. I am a holder. I'm a fan of JD, and I think this is a good potential purchase. So it will branch JD out into the southern US states quite nicely. And I think at 1 billion, as you can see, if I knew about Hibbett, I think I might have actually bought them because their financials look pretty impressive, and their share price had jumped 18% on the back of the news of the buyout. They were trading at around 7.5p or something like that. Now over 8, which is still not bad. And as you can see, if we just go on to the income statement first, we just see their revenue had been nicely growing from 2020 to 2024, and also so is their net income has been a bit fluctuation, but there was a good year just after the pandemic, but since then it's faster growing than it had been before the pandemic anyway. And they'd been purchasing back shares a lot, very quickly, from 18 million all the way to 12 million this year, 2023. So yeah, I think this could be a very good addition to JD's Sports portfolio. And at 1 billion, and JD Sports is they're about 6 billion market cap. And they had about 1.5 billion spare cash, but a very feasible buying opportunity. And I think something that will help JD Sports branch out into the further states in America. Anyway, I think that's all from me today. I will make another video on about 2 stocks, UK stocks that I'm buying, but I'll leave that for another day. As I said at the start of the video, please like and subscribe. It really does help out this channel. Thank you and have a good day.